Hi, everyone. Welcome back to our podcast, The Ins and Outs of Selling a Business. Today, we're going to continue our conversation about that dreaded four-letter word, exit. And we are really excited to bring back Richard Austin. Hi, Rich. How are you?
Hey, Keith, how are you doing?
I appreciate you coming back. I know you have a lot on your plate handling your clientele throughout the country. Rich is a executive director with Integrated Partners. They are a independent registered investment advisory firm. They have a national footprint, over 200 advisors, and they're managed just north of $16 billion in assets, and the company's been around since 1996. So, Rich, last episode, we talked a lot about the planning process, and we kind of introduced a little bit about continuality type of planning as well with the family or closely held companies. And there's a lot to unpack, right? So I thought today that we can talk a little bit about some case studies, some strategies that you guys specifically use. I know some of this thing may seem dry to our audience, but the fact is we like to eliminate surprises. And one of the biggest surprises is tax implications. We always ask before we take a client on, if you talk to your wealth management firm like Integrated, have you talked to your accountant about tax implications, possibly an estate trust attorney about strategies put in place prior to selling your business that things that you look to do that take care of your family or charitable giving? And some people have, but most have not. Right? So we look to say that you should start those conversations now. We have plenty of time before we sell. Typically, the initial meeting of a client, if they sign that day, it's 9 months to a year. Usually by the time of our first meeting, it's another couple months before they sign up, so they can start getting their house in order if they haven't. So from your perspective, the number one thing that our clients always focus on is taxes. What's it going to cost me, right? And some have, CPA firms they use are good firms, but they're not really specialized in this aspect of it. So I'd love to hear a little bit about how you guys approach that, because it's critical.
Yeah, so thanks, Keith. So last podcast was a focus on a four-letter word, right? Exit. So this one's a focus on a three-letter word, tax, which, can be pretty detrimental, to a client, whether you're talking about an income or estate tax. And I think to kind of step back and kind of, look at his example, how we work together. And, and that's a good example of, when you're working with a business owner, it's a team, it's a group working for their benefit. No one is a specialist in everything. At Integrated, our, business owner solutions team has decades of experience in working with business owners in bringing together the wealth management side from the tax planning, with the business succession and exit planning. So, and what I mean by that is kind of, looking at every aspect of a complex client's life, like a business owner, and looking at knowing the entire financial picture and understanding their goals, and then stepping back and saying, okay, you might not exit for a year, 5 years, 10 years. You don't even know when your exit is going to be. We know that, looking at, your assets, there's probably some transfer opportunities or maybe a restructure, of the business for some tax savings. And a lot of times it's about being proactive with a business owner. And I think other advisors don't have the perspective. If they have the perspective from a financial wealth management side that we can have, because in order to make a decision or propose a strategy to a business owner, you really have to know their entire financial situation and their objectives. And I think that other firms, like most, not all law firms and accounting firms, they're not built to kind of, to really understand that whole financial picture. So it really puts us into a position to identify opportunities. But then most importantly, it's to work together with the team to collaborate to bring the right result, the best result, to the client.
Yeah, I think you're right. I think there's a number of advisors that are assembled, as part of a team. And I think you're right. Some of the accounting firms are extremely busy, so they're really compliance oriented, right? They're making sure your taxes are done, making sure you're filing this, making sure you get your financials done, and then they kind of used to do all the 5500s and forms for your pension and your 401k plans, but that's now specialized with consultants to do that. And so someone who take a broader view of your picture, like integrated in this case, say, okay, what's your ultimate goal, right? And it's just like you said, there's one business owner. It could be multiple. It could be three people, three owners, four owners, two different families. But it's not like just a family, right? It's not like the two brothers or brother or sister. It's their kids, right? And their kids, and it kind of like trees out. And in most cases, you run into and you'll see the same name, in the organizational chart at some position. And whether or not they're interested in staying with the business, what they anticipate, that to me can be create a very complex situation when you're starting to sell, because all of a sudden you and I decide, okay, we're going to sell, but then all of a sudden the family member's like, what does that mean for me? And so how do you kind of address that? So it's very complicated, I know. But communication is key, right? I mean, transparency, letting them know. I mean, I know clients that will hold everything to the vest and at the end, and it could cause issues when you're ready to sell, because your son or daughter could be a key employee and they could get, let's say, hot about it, emotional about it. And if the buyer sees that internal strife, among the team, they're going to get concerned, and they're going to be a little skeptical about, do I really want to do this deal, or do I want to do it this price? So it all plays together. So, I'd love to hear maybe how situations where you may have run into or, address these kind of challenges.
Yeah, so challenge. So with a business where there's key employees that are also family members, maybe they don't have a piece of the equity, or maybe it's a small piece of the equity in the company. They're tied to that company. They've built their career. When there's a change in control, there's a lot of emotions, and there has to be conversations with the entire family. But really, the one in control is the majority owner, the patriarch, matriarch of the family, whoever started the business, and kind of like understanding what the top values you can get for that business. Maybe there's mitigating the tax impact on the sale. We'll talk about some of those strategies. But maybe there's an opportunity to kind of like transfer some wealth, or some of the stock, prior to the sale, to those children at a lower discounted value.
Right.
Maybe use a trust to kind of control the value, right? So using a legacy trust from a transfer, taking advantage of discounts, whether it's for lack of minority interest or lack of marketability. And conservatively, those could be 20, 30%. That's what I've seen, but even higher than that. And so there's just different ways to kind of go about it. But ultimately, it's stepping back to the goals of the business owner themselves, and the senior generation, and kind of like understanding it might be a great time in the market to transfer the business. Maybe there needs to be an understanding at the next generation. Maybe they're not built to kind of take this business to the next level. Maybe, like we had talked about before, maybe there's some rollover equity that the children receive, in the new business where they're kind of involved. And you can always protect a key employee by putting some employment agreements in place,
Right.
as part of the sale transaction. But I think when you step back and you look at the tax impact on a transfer or a sale, and you want to mitigate that, it really focuses down into income tax, estate tax, and charitable giving. And here we just kind of sort of talked about like, using discounts, making a transfer over to a trust or to the children from an estate tax standpoint. There also could be some income tax planning there, with let me take an example with a widely used technique, especially and I've used it a lot in the state of Massachusetts, with clients. In New York, it's not available. So there's an incomplete gift trust. So let me break that down for a second because it just sounds like, what is that, right?
Right.
So,
Exactly.
so when a client wants to save taxes on a transaction, one of the tools in our toolbox is kind of saying, okay, what if we used a trust, but it's not your typical trust? What if we use one where you and your spouse and you can be beneficiaries of that trust, but maybe you're not going to access those assets for a period of time, a year, 2 years, 5 years. Set up that's really the importance of setting up the plan, right? Having different strategic portfolios and assets, of where assets are going to be pulled from in 5 to 10 year increments, and managing those portfolios in that way. So if prior to the sale of a company, part of the stock is put into this incomplete gift trust, where it's incomplete because it's an irrevocable trust, but it's incomplete because the one who's transferring the gift into the trust is a beneficiary of that trust. So you can't do that in every state. Some states have laws that restrict you from putting that in place. Massachusetts, you can accomplish that. We're putting one in place for a business owner down in the state of Kentucky. There's only a handful of states that you can't do it off the top of my head. I know New York and California, you cannot do it. They have legislation that restricts it. But when you put this into place, you use a trustee in an asset protection state, such as New Hampshire or Delaware, and that trustee oversees the trust. And there's a distribution committee, that's put into place. And we can go into more of these details, but I don't think it's necessary for today's call. But the ultimate result of using an incomplete gift trust is, I've done it with companies that are structured as C corporations and done at the right time before a sale, you can save the state income tax, on the sale of the business. So let me quantify that example for you. So we had a client who sold their business for $40 million. They decided to take $10 million of that C Corp interest. And the client was 100% stakeholder, owner of the business, started from scratch in the 90s. But for this, and before I go any further, Section 1202, the qualified small business stock
Right.
exclusion,
Yep.
or excluding the gain, didn't apply to them because of how the company was originally capitalized. So we looked at that first. So here we're okay. There's an opportunity to save state income tax in the state of Massachusetts. State income tax is 5%, but they also have what's called a millionaire's tax that they enacted. So that millionaire's tax is another 4%. So let's make the math. So 9% on 10 million is $900,000. Just putting this one technique in place. This is one of many different techniques that are available. We were able to save the client $900,000 in income taxes, at the time of sale.
It's interesting. The tax planning aspect can be daunting and very complex, and business owners are they're really focused on income tax. Right? I mean, I literally have a couple of clients over the last couple of years that we sold where we had a dynamic spreadsheet. So as the bids came in, right, we get multiple bids and letters of intent per deal. They would plug it into the spreadsheet to see what their income tax effect would be.
Yeah.
Right. And so every time we negotiated, whether it's increasing the purchase price or buying the fixed assets at a reduced value, not step up, so ordinary versus capital gains, they would plug into this spreadsheet and say, okay, it's going to cost me X, so my net's what, and they always look at the net, right?
I love when they do that.
Yeah, because we don't want any surprise, but there's a whole realm of planning tools with, approved IRS, we'll call approved trusts that you can utilize to kind of preempt some of this stuff that is already taken care of. Like you said, I mean, we had a deal we closed last year on December 31st in Massachusetts. and it had to close on December 31st because of the millionaire's tax, right? So, and the big question was, well, how am I going to get the paycheck out, and prior to my payroll processing company couldn't do it quick enough. So I said, just write it manually, right? Write it manually. They don't have to. It's just during your process. Write it manually, deposit it, and give them the information because and they'll put it in the W-2s because you could write the check. It doesn't have to be through your payroll company because it's coming out of the same purse, right? So, but it was a huge deal. If we don't get this done by December 31st, we may not close. All over. Yeah. Well, there was 5 people. It was probably about $2 million of additional tax to the ownership group. And they're like, wait a second. But a lot of that can be mitigated through proper tax planning and utilization of various trusts. So, so you work a lot with your client base. I mean, all over the country, your advisors are calling you and your team, hey, we got the situation. How can you help us? What would you say some key takeaways about Integrated is, and yourself and your group, that you want to share with our audience?
Yeah. So, I think selfishly, I think we're unique in the industry where, myself, for example, being, an attorney with a master's in tax law, and then our other team members, credentialed, having resources, in dedicated groups like, with complex clients, high net worth, family office services, business owner, where my group leads those conversations with those complex clients nationally, with our advisors. So it allows them to be really good at what they do on the wealth management side, but then provide those resources and collaborate with CPAs and attorneys. An attorney called me the other day from out west, and working with one of our clients, and had a design strategy that they wanted to use, with a client, and it involved the use of life insurance, and it was a generational type play with split dollar. And we talked about it, and we both go to a tax conference every year down in Orlando. I've been going for over 20 years, and you get to know the right players in the industry and what strategies are available. And none of these strategies are pushing the button. I think like our firm and the strategies that we propose, they're conservative. I'm not looking to have our clients be audited. I'm not looking for our clients to, and if they are audited, they're going to win the audit. And these are conservative techniques that are basically codified techniques that are available through the tax code. It's just using the tools that are available, for you, and being proactive, on the tax planning piece. And so that being said, whether you're looking to accomplish like income tax strategies or estate tax, it's about understanding the whole financial picture, doing some work beforehand, bringing the team in, talking about it. I'll go micro for a second and give another example. So we had a client who was wanted to, at the sale of his business, wanted to give $5 million to charity. So, and we have a great relationship with we're multi-platform, Fidelity and Schwab and other platforms where, we can utilize their charitable resources, and they have great teams in place. And so one of the issues sometimes with doing charitable planning prior to the sale of a business, and you can attest to this, Keith, is that a business owner doesn't want to give away their stock to charity, and you have to do it before the sale is actually going to complete, or is you have to do it before it kind of gets to that point where the IRS is going to be like, no, it was definitely going to go through. You can't get a tax deduction, so there has to be some risk on the table, right? So sometimes using a donor advised fund, for charitable purposes, is hard to complete before a sale because you don't have enough time, because the donor advised fund has to do their due diligence. Our team came up with a really creative strategy. And I, over the years, first time I used it was a couple of years ago. I've used it with a few clients. Is we used a charitable remainder trust. which is not anything new, right? But a charitable remainder trust, you usually set it up to smooth the income from a sale over a period of time. So you basically have the client takes back some income, but they take it back over time. So they're taxed at hopefully like a lower tax bracket over time, or maybe they move to a lower or no state income tax state. So setting it up for like a 20-year period, lifetime. But what if you used a charitable remainder trust for like a 1 or 2 year period? What it does is we set it up for 2 years. And if the client was able to get 90% of the tax deduction, but here was the game changer. The client is also the trustee of the charitable remainder trust. We didn't have to go through all the hoops of due diligence with the donor advised fund. We're able to put it into place, 60 days before the sales transaction was complete. And it was a win-win overall from charity's perspective and from the client's perspective, and they loved it.
Richard Austin, Integrated Partners. Thank you, everybody. Again, my name's Keith D. I'm president of Osage Advisors. Osage Advisors is an investment bank working with family close-sale businesses looking to sell. Typically, our clients have upwards of $5 million to $150 million of sales. To learn more about Osage Advisors, you can visit our website at osageadvisors.com. If you enjoy this podcast, please feel free to subscribe at our YouTube channel, The Ins and Outs of Selling a Business. You can email me with any questions at kdee@osageadvisors.com, or feel free to give me a call at 860-767-3273, extension 1001. Thanks again, and have a great day.